So to get started off real quick, just normal disclosure: trading futures, options, Bitcoin, whatever, is going to cause obviously risk, and you have to decide what's best for you. Okay. So with that being said, let's go ahead and get going. So first, I want to go into what is an option. If you want to buy a house, okay. So here's an example for you. If you want to buy a house, and I've actually done this before. If you want to buy a house, but let's say you don't have the money at the moment, then you can buy an option on the house. So, for instance, I was actually wanting to buy a house on the lake, and but I wanted to pay cash for it, and so I was waiting to be able to see, what would be the best choice for me in doing that, and so I went ahead and put down $1,000 for the house. And that gave me the right to buy that house. It was a small little house on the lake. Right to buy it for $100,000 within the next 6 months. He couldn't sell it to anybody else. They would have to buy from me first. And so if they wanted to pay $150,000, great. They're going to give, $150,000 to me. I'm going to give $100,000 to him, and I'll make $50,000 on it. Okay? So the house goes way up in value. Then I benefit. If it goes down in value, well, I can decide just to not buy it, okay? And the most I'd be out is that premium I paid, the $1,000, just like when you buy car insurance or whatever else. So if I don't buy it, the option just expires, and the person who sold it to me gets to keep the $1,000. So they provided the house, and they put the money up. Now the house goes up again to $200,000, and I paid $1,000. I have $100,000 in equity, positive, in the house, plus I'm down the $1,000 that I paid in premium. If the house drops, then it's like, say it's worth $75,000 in the next 6 months. I can choose not to exercise it, give up my $1,000, but I'm not going to lose a $25,000 decrease in the home's value. So I've actually had this happen before, where I've went in and when I bought this house, or bought the option on this house, there was a massive fire, burned down all the houses on the lake. Obviously, I chose not to exercise my option. Okay? So in addition, you could resell your option that you bought from someone else. So let's say I buy it. It's going up in value. So they have the right to buy it for $100,000. And 3 months later, it's worth $125,000. I could go in and sell it to them for, say, $25,500. They would then have the right to buy it for $100,000 before the option expires. Maybe they think it's going to $200,000, or maybe they just really want it for whatever reason. Okay, that's one of the ways that options can be used. We actually call that a call option. It gives the buyer the right to call it away from the seller. Okay, so one of the things I think of is pick up the phone when someone calls you. So call option thinking it's going to go up in value when you buy it. The strike price gives you the right to buy it at. So, like, say, at $100,000. The expiration date is 6 months from today. So there's an expiration on the option. How long do you have that right? And the premium you pay is $1,000. Now, premium can be made up of two different things. So some big words here: intrinsic value and extrinsic value. And again, you can trade options on Bitcoin and futures and Forex and stocks and all sorts of things. So in this case, we're just talking about, houses. So when the house is worth $100,000 and you bought the right to buy it at $100,000, the $1,000 premium you paid was extrinsic value, because it really had no value besides the right to buy it. Okay? So it was a time value. You're buying time to lock it in at that price. However, when you sold the option to another person for $25,500 and the house went up in value to $125,000, you received $25,000 in intrinsic value, like actual real value, because the house was worth $125,000 now. Okay, so if it's worth $100 and you're selling it for the option for $25,500, you got $25,000 in real value. Because remember, it's a right to buy it at $100. It's worth $25,000. So that difference is your real value. The $500 is time value. Okay? So, again, the $500 is simply time value. And, there's only 3 months remaining. So the premium on this, in this case, it would be, let's say worth half as much. Not the real value, but just the time value, the remaining 3 months. So they have the right to buy it for $100,000. They paid you $25,500 for it. So you got $25,000 in real value. You got $500 back in premium. You actually did pretty nice on that transaction, right? That's a call option. And again, you can do this on stocks. You can do it on Forex. You can do it on futures. You can do it on commodities, indices, Bitcoin, things like that. So now there's some other words you need to know for what a call option is. Okay? At the market. So ATM. When you bought the option to buy the house at the strike price of $100,000, the house was worth $100,000. Then that's known as a at the money option. Okay? As it is literally at the price the value of it is currently worth. If the stock was worth $100 and you bought a $100 strike, that'd be an at the money strike. Now, options that are at the money are the most expensive options because they are all premium, and so basically a 50-50 chance there, and so you're actually going to pay the most premium on an at the money option. So notice how in our example is $1,000, it went up. So the more out of the money or in the money it is, will actually reduce that premium. So let's talk about what does out of the money mean. Well, out of the money, if you'd have bought the option, the right to buy the house for $100,000 when it was just worth, say, $90,000, then the price would have been less. So say you just had to pay $200 for the option. So the house is worth $90,000. You're saying, you know what? I want the right to buy this house for $100,000, higher than what it's worth right now. Sometime in the next 6 months, I'll pay you $200 for that right. The person can't sell it, but hey, if you're going to buy it, you have the right to buy it for $10,000 higher. So the house goes to $125,000, they come out, or $100,000, then they came out great. If the house goes down, they still got to keep $200. If it stays under $100,000, they still get to keep the $200. So this is good to do, as it's a lot cheaper. It's out of the money. So if you decide to exercise it in 6 months, then you'd have to pay not only $200,000 plus the $90,000, the house cost for $90,000, $200 for a house that's worth $100,000. If it stayed down, if it went up, then you'd have to pay the difference there. But you wouldn't have to pay anybody else. Now, if it's in the money, when you sold the $100,000 strike option to the other option buyer 3 months later, when the house was worth $125,000, okay? So again, when you sold the house for $25,000 in the money, the strike price inside the actual value, the right to buy is $100,000. Then it's worth $125,000. So you got $25,000 worth of in the money, plus you'll have premium, like maybe $500 or $200, just depending upon how far it is in there. So to make it a little simpler, if you're buying the option to buy something or sell something, but if you're buying that option and you're buying it at the price the current whatever it is worth, then that's at the money. If you're saying, hey, I'm willing to buy it at a higher price than it's worth right now, that's out of the money. If you're going in and saying, hey, I'll buy it for the price, a lower price. So I'll go in and it's worth $125,000. I want to buy the $100,000 one. Well, then you're going to pay all the intrinsic value plus the premium. Okay. So why would somebody do that? Well, that's a way to sort of get closer to trading in stock at a closer, what's called a delta of 1-to-1, where they have the ability to mirror the stock's movement, but not have to put up the full money of the stock or half the money like on a Reg T margin account. Okay? So that's why somebody might do it in the money. They do it out of the money because they want to pay less money and make money on the expected movement, and at the money because they think it's going to move up some. So there's different reasons to do each one, but it's first thing is just you have to get the vernacular of the options. Okay? You have to understand that there's at the money, out of the money, and in the money options. Okay? So now let's talk about a put option. What is a put option? Put options are great, especially if you're, trading really volatile instruments. Right now we have, obviously, the indices are super volatile. We have things like Bitcoin super volatile. So a put option is really all about risk in the real world. Like, how do you cover risk in the real world? If you have a home, you buy homeowners insurance. If you have a car, you buy car insurance. For your health, you have health insurance. For life, you have life insurance. So, but what about your investing? What about your trading account? Well, put options are similar to insurance. It can be used for stocks, forex, futures, and some cryptocurrencies as well, like Bitcoin. So, if you have homeowners insurance and the house burns down, then you can get a reimbursement from the home burning down, right? If you have a put option, insurance on a stock or a cryptocurrency or forex or futures, then you can get reimbursed for it burning down. And there's people I know that would like that had stocks or had, maybe Bitcoin at 20,000, or they wish they would have had some options on that. Okay? So, in addition, you can buy put options on, like I said, stocks, forex, futures, and some cryptocurrencies that you don't even own. So you can actually buy the insurance on something you don't own. Imagine buying insurance on people's houses or life insurance on somebody else, or it sounds sort of weird. But you can buy options. You can buy insurance. So if they go down in value, okay, if their stocks go down in value or futures go down, you can actually just buy the option and put up a lot less money and cap your risk. Okay? And if you're right about the direction, whether you buy it like a call option or a put option, then you don't have to buy the underlying, or you can use it to hedge the underlying, either one. And hedge meaning like reduce your risk on the underlying market. So if you have a house that is worth $100,000 and you then buy insurance, okay? So let's say you buy that $100,000 house. Yeah, you did it, whatever, you bought it, okay? And you buy a put option, aka insurance, for $100,000 strike price. So you're saying basically the house is worth $100,000, reimburse me if it burns down to the ground. Now it may cost you $1,000 for the insurance, right? You got to pay insurance premiums every month, every year, every quarter, whatever. So, because the policy is at the market. Now, if you only want to cover like $90,000 worth, it'd cost less, right? Or if you want to cover the house and you want to cover vehicles or contents or whatever, all those things would add up. But let's just say the $100,000. So if the house does burn down to the ground, the stock, the cryptocurrency, the FX pair, whatever, you're out $1,000, but you get back $100,000 from your insurance company. You only lost the premium instead of the house. So that was your reduced risk. You reduced your risk to your premium, $1,000. Now, if you bought an insurance policy when a house is worth $100,000, and you had a strike price to say $90,000, for $90,000 to be reimbursed if the house burnt down, then that'd be like having what's called a deductible, a $10,000 deductible. Okay, so an out of the money contract. Like if I bought a put at $90,000, so the loss, the deductible would be that first amount it has to move. The loss in value of the home. They would not get back on the insurance policy. So the house burnt down to the ground, you get $90,000 back. You'd be out $10,000 from the deductible, right? Like in value at least. But you only pay $200 for the premium. So could be worth it depending upon how likely you think it is to burn down or not burn down. So again, the premium is cheaper since the put option is out of the money, and there's a deductible amount that you'd not be reimbursed for. Okay, so if Bitcoin, a stock, whatever, if you're buying it higher, or you're buying a call higher, or buying a put lower, it's going to cost less, but you won't really make a whole lot in between that point and where it gets to that. Okay, that price, that strike price. Now, there's also something called credit and debit spreads. You may or may not have heard this, depending upon if you have any, experience trading options. So again, some people liken spreads to being, debit spreads. If you compare, spreads to vanilla calls or puts on a Friday, like on the CME, for instance, the CME being the main futures exchange in the U.S., the pricing will be nearly the exact same. A spread and a call, like when there's just a day left, there usually won't be much of a difference in the price. Okay? So less than 24 hours to expiration, they act like a simple call or a put from the, floor to the center, and then the opposing from the center of the floor. So they're basically going to price like a call or a put. So now understand, there is no such thing as a credit spread. As in all spreads, you are debited. You have to put up the risk. The reason people call them credit spreads is due to the premium, the intrinsic value. So if the premium is in your favor, like you're the insurance seller, okay, then if time goes by, you collect that premium if nothing burns down, right? But if you're a premium payer and nothing burns down, you get debited. So really, credit and debit doesn't refer to the money taken out of your account. It refers to whether time is in your favor or against you, okay? So you think about it, your insurance agent, right? Time's in, or the insurance company you buy from, time is in their favor for every day that goes by that you don't file a claim because they're collecting that premium. Okay? Whereas as your insurance payer, time is against you, right? Every day you don't file a claim, which isn't a horrible thing, but at the same time, every day you don't file a claim, then that premium is going, out in value. So you only recover most of your, money, maybe more, whenever you file a claim. So if the premium's on your side, you make money now implied volatility is another thing. This is really interesting too. We've had a massive spike in implied volatility. Last week, we had the 7th largest spike in implied volatility in history when the markets all crashed down. So, that means all the options got more expensive. Why would they get more expensive? Because implied volatility. What does that even mean? Well, implied means expected. Volatility means movement. Okay? So the more expected movement there is, the more an option is going to cost. So if you think about, a 16-year-old male getting insurance on his first car, right? He's going to pay more than a 45-year-old male with the exact same, with a good, clean record of driving, right? Because there's a lot more expected volatility of that 16-year-old driving as he slams on the brakes and does donuts and slams on the gas pedal, at least more often than the 40-year-old male, okay? So as implied volatility goes up or down, it'll be more expensive. It'll make the option move slower, okay? It'll mean if you're a collector, you'll get more, but there's more risk, okay? If you're somebody who's paying, you'll pay more of the premium. But again, you're taking on a contract that has a lot more, risk built into it, okay? So sort of just lets you know if the premium is on your side or not, credit and debit spread. Now, let's talk about a different kind of option that you may or may not know about. It's called Nadex Spread options. So all the contracts on there, they have two different kinds. They have a binary contract, they have a spread contract. Today, we're just talking about the spread option contract. Okay? They are completely different, two different worlds. If you don't like or want binaries, whatever, that's fine. I'm talking about the spread options. Okay? The Nadex spreads. They have two different strikes. They have a floor and a ceiling, just like a call spread or, put spread. If you buy it, it's a call spread. If you sell it, it's like a put spread. So they're all option spreads. They are options, which means they have things that in optionality that impacts the price. Most do not mirror the underlying market. There are a few that do. If IV is not too high, then you can usually trade what's called the daily near the market contracts. And we'll talk about that, later in either the show or one of the next ones. Okay? But most do not mirror the underlying market. So you do have options. And that's the nice thing about options. You have choices. You have different ways you can trade directionally. Or even if you think it's going to be flat. So what is a Nadex spread? Why would you want to trade them? What's the value? How do you trade with reduced risk? What does moneyness and optionality and movement mean? What does premium proximity? What does all that stuff mean? Well, that is part of what we're going to talk about in this series on Nadex Spreads. Is we're going to help you understand how to take advantage of these options. So again, if you're trading futures or Forex or stocks, you can learn how to use these on, major stock indices, commodities, energy, energies, metals, things like that. And again, even on cryptocurrencies, like they have them on Bitcoin. So you can use these spreads on those as well. So there's a lot of different ways that you can trade these contracts. So I want to teach you about this, help you understand it, and maybe it's a way that something that you can add to your trading arsenal for a way for you to reduce your risk, and or whether by using them to trade or using them to hedge the trades that you have. So if you want to open a live account or just a demo account, you just hop on over to nadex.com. Okay? And let me pull that up here, and I will show you where the link is at, just so you sort of know. I obviously recommend that you grab a demo account to begin with. So, and then, once you sort of understand the contracts and you're ready to go live, then of course you can always fund. I think it's like $500 or something, $350, $500 to fund an account. It's pretty cheap. And you can actually trade contracts for that little. So, you'll go over here, and to open an account, there's a little yellow thing right there. Also, you can go over to trading platforms, and you're going to see there's a demo trading platform. You click on that and fill in the information, and you can actually open up a practice account. Okay? And they'll fund it with $25,000 of just what's called paper money, funny money. And it sort of always paper funny money, but this is money you don't have to worry about losing. It's a lot less expensive to make your mistakes in a paper trading account. Also, once you've done that step or created your live account or both, you can hop on over to the Nadex platform, nadex.com, over on your mobile phone and log into their mobile platform. And they have one for tablets as well. So, and it's all web-based. So you don't have to download any software or anything like that to be able to use their platform. Now, if you want to... Now, one thing I can tell you about the Nadex platform, I love the contracts, but there are a lot of options. And it can get pretty intimidating with how many options there are. Okay? Let me bring up the Nadex platform, and I'll show you sort of what I mean over here. So I'll just log in to my demo account and to sort of show you what it looks like. So there's all these contracts. You got cryptocurrency spreads with Bitcoin. You got indices spreads. Again, I'm talking about the spreads, not the binaries. So on the DAX and the Dow and the FTSE and the small caps, the S&P 500, NASDAQ. We got Forex. You got multiple currency pairs: Aussie and Aussie dollar, Euro pound, Euro yen, Euro dollar, pound yen, pound dollar. So, and then you got commodities. So you got copper and coin, crude oil, gold, natural gas, soybeans, and silver. So a lot of spreads on there that you can trade, that you can take advantage of. Now, this can get, like I said, really intimidating because you can have all these contracts on here, and you're like, well, what contract do I trade? Which one do I want to use? And like I said, it can get sort of intimidating on what to do and how to do it. Well, myself, I've actually made a free platform that goes on top, sort of a skin that goes on top of the platform. And if you go over to apexinvesting.com and just sign up as a free member, I'll be adding a link at the top here that'll have like a tools link as well. But you just sign up as a free member right there and then log in. And then once you're logged in to it, then you can actually go to the scanner. Okay? So we have a lot of different, right here, there's a scanner where you can activate it. So once you activate it, then you can go directly to it. And you'll be able to see everything just a lot simpler, a lot easier for you to be able to trade. Get some announcements in there, clear those out. But you'll be able to see over here, if I want to trade, Bitcoin contracts, or I want to trade the NASDAQ, all the contracts are right there. But here's what's really nice about this. A few things. One, there's an instant ticket, so you can literally just click this lightning bolt once you enable it, and boom, it'll fire the ticket off for you. Two, it'll show you the risk reward right there immediately. The other thing is it'll show you how far away from the market the option is. So remember I said that optionality, that premium, that extrinsic value? Okay? That's what that premium is right there. That's your extrinsic value. So whether you're getting debited it, like negative, or credited it, like it's in your value, it'll show you that. And it also lets you see multiple expirations without having to click through different expirations. Sort of over here, you're going to have to go through and click on each expiration to see each contract. Well, like those are both expiring at 4/15, but I have to click around to be able to see them all. This one I can actually see all the 4/15s just lined up together with the risk and reward. I can see if they're in the spread, out of the spread, near the market, on down the list. And often what I'll do is I'll trade the near the market spreads. So because they more mirror the market. Okay? But there's a whole tutorial section on here that teaches you how to use this and more about how to trade on Nadex and everything else. So anyway, just check that out. Again, nadex.com and under the platform at the top, and then in apexinvesting.com to sign in as a free member, and you can go over here and click on the scanner and get access to that to help you out. And there's tutorials and stuff as well on the spreads and the binary. So just some more helpful resources for you if you're wanting to do that more. All right, so enough of that. Let's go into more of the education side. Let's check it out. Like, is this worth trading? So let's do like a capital comparison. So, how much money would you have to put up? What's your leverage like if you were going to trade these contracts? Okay? So, fair question. How much would I actually have to put up to place a trade? And this isn't exaggerating. Okay, now I put, obviously a little bit different price than where the market's at right now. I just had a standard price to make it simple and easy. But if I went in and I wanted to buy 1,000 ETFs on the FXE, that's the Euro-Dollar ETF, or, you think about indices, you have the SPY and the SPX, and you have the ES futures and, things like that, right? Or on Bitcoin, you have the Bitcoin futures now. And, they're working on all the ETFs, and you have the spot, and you have margin over at like BitMEX and different things like that. So there's different ways that you can trade all these contracts. You also have them on Nadex as spread options. So looking at this, we got the FXE Eurodollar ETF. If I had to buy, I'd have to buy 1,000 of them to get up to $125,000 worth. Okay, so 125,000 units of currency would get me $125,000 worth. The futures are priced at $12.50 a tick. One future is actually worth 125,000 units. That's why I used 125,000. The options, you could also do one option contract on the futures. Okay, and that would be worth one future. It'd be 125,000 contracts on that one option. Or options on that one contract, depending on how you look at it. And then on the Nadex Spreads, okay, I'd have to go in and basically do like 10 Nadex Spreads. Or 12 and a half, I guess, to make 125,000. Okay? So what about the price? So if we look at, all of them at 125 or 1.25 or, 0.01 like on a Eurodollar future, what's the leverage value? All of them equal, $125,000. Okay? So whether it's a future or an option or a future option or a spread or whatever. How about how much money I have to put up? And this is a big kicker. Okay, this is something that'll be like, wow. Well, to trade the ETF, I'd have to put up $31,250 in day trading margin. I'd have to put up even more than that if I didn't have day trading margin. So I'd have to put like $60-something thousand for like Reg T margin. On the spot, you have to put up $3,125. Okay, that's how much money they'd make you put up to control 125,000 units of Euro-Dollar, depending upon your broker. So let's assume it's 50 to 1. So Euro-Dollar futures 6E for day trading margins, $500. So pretty low. Of course, there's also a floating P&L. So as it goes against you on all these, you have to put more money up, except for on the options. So on the future options, like on the CME, it costs you about $2,500. Okay, a month till expiration. So $2,500. On Nadex Spreads, for the exact same leveraged value, you only put $250. Do you see that? And by the way, that is your maximum risk, $250. The other one, you're putting up all that money, plus you still have the risk of the total value of the contract. This one, your risk is $250 to control $125,000 worth. So on the ETF, that gives you a 4 to 1. On the spot, that gives you 50 to 1. On Eurodollar futures, that gives you 250 to 1. On the future options, that gives you basically 49 to 1. But on Nadex Spreads, 500 to 1. And usually people go like, leverage, well, that cuts both ways. Well, yes, it does, unless you're using options. So if you're using bought options, okay, or sold options that have a capped risk, like a spread, then you have capped risk on a spread option. Okay? So my risk can't get any greater than $250 on this, and my leverage is 500 to 1. So massive leverage, low risk. You go over and you look at some of these exchanges that'll give you 50 to 1, or exchanges outside the U.S. might give you 100 to 1, or, maybe in the futures exchange you might get 250 to 1. Not from the exchange, but from your broker. And then you go to brokers outside the U.S., and maybe they give you 500 to 1. But that's like 500, ticks per tick move in value. So that can knock your account out pretty quick because it cuts both ways. In this case, it doesn't. You don't have, your cap is all the way up to the ceiling of the contract, which can be pretty high. Okay? Way higher than what you expect it to move in a day, in most cases. So there obviously are these crazy volatility days, but still you had a great risk-to-reward leverage ratio. So let's look at it. Let's say if it moves up to 27.40 to the ceiling of the spread, expires there, whatever. How much would you make on the indice? Or not the ETF? You make $3,000 on that move. You spot your dollar, you make $3,000. Futures, you make $3,000. The future option, you'd only make $463 because it has an insane amount of optionality in it because the expiration is not today. It's gonna, unless it's a Friday, it's gonna be like this week or in a month. So somewhere between there. So it's gonna move a lot slower. What about a Nadex spread? Well, 28.75. Well, that's a little less than the 3,000. Okay, but considering I got 500 to 1 and I put up way less money than any of them. In some cases I put up less than 10%. 1% on one of them. I made literally like massive leverage, low money, and I made approximately the same amount of money in the same move. Now, what if it moves down all the way, below the floor of the spread? Well, on the outright, if you went and did the FXE, then you would lose $3,100. On spot, you'd lose $3,000. On futures, you'd lose over $3,000. On the option, remember the risk is capped, so you only lose $1,250. What about the Nadex spread? Well, the most I can lose is what I put up on a spread, $250. So I put up $250. I could only lose $250, even though it moves like a ton against me. Okay? But if it moves in my favor, I can still make a lot. So now I have leverage, margin, all that working for me. So, think about that as you have a better use of your capital. You have more risk control. Okay? That obviously is going to help you because it's like investing more but putting in less and capping your risk at the same time without really capping all your profit potential beyond the ceiling of the spread, which if that happens, that's a good problem. That means you made, quite a bit of money, depending upon, of course, as long as you bought it where there was some room. But haven't really found that to be an issue. Anyway, so, this is something worth looking at. And again, this is not just FX. This is S&P 500. It's Bitcoin. It's, NASDAQ. It's oil. It's gold, silver, copper. There's all these different markets you can trade these on. So again, all the products on the exchange, the Nadex exchange is the North American Derivative Exchange. All of them have capped risk. So it's a U.S. regulated exchange, and you can't lose more than you put up in risk. You still get amazing buying power. You can trade, like I said, stock indices, commodities, forex pairs, and Bitcoin. So the crypto that they currently have is Bitcoin. I'm sure they'll be adding more in the future. They have Spot FX. And by the way, they have weekly and monthly contracts on Bitcoin, which is really cool. So the other contracts on the spreads, they're daily or all the way down to like 2 hours. Now the Spot FX tracks the FX markets. Okay, it doesn't track the futures FX. So you want to be looking at a Spot FX chart. Euro dollar, pound dollar, Aussie dollar, dollar yen, euro yen, pound yen, dollar franc, dollar CAD, Aussie yen, and euro pound. Commodities, a commodity to make it simple is if you drop it on your foot, it hurts. Corn, like a bushel of corn, right? That would hurt. Barrel, 100 barrels of oil. So natural gas, gold, copper, silver, soybeans. So any of those are commodities. You can trade those on Nadex. They have U.S. indices and international indices. So they have the S&P 500, the NASDAQ, the Russell, the Dow, international indices. But by the way, these follow the futures, not the ETFs. So you don't look at SPY to look at the S&P 500. You want to look at ES. And on the scanner, we actually have the future contract and the month that it's following listed. And we tell you how to get access to the data and everything else. FTSE 250. So on the FTSE 250, that's in London, FDAX in Germany, the SGX, Nikkei 225 in Singapore. Again, there's not the CME SGX, though it usually, the yen version is what it tracks. It usually does track pretty close to it. But just for exactness, it follows the Singapore exchange. So, talked about this a little bit already. They're pretty much, as little as 2 hours. And now you can get in and get out in 10 minutes. Okay? But, they have contracts that will expire literally every couple hours or every hour at a certain time. They start at a certain time. They have daily contracts. They go up to 22 hours and 15 minutes. So you can trade these things at night, during the day, during lunch, Euro session, early in the morning, around the clock. Larger time frames will be wider between the floor and the ceiling because there's more possibility of movement, right? So, and shorter time frames will be narrower. So, because there's obviously expected to be less movement during a shorter time frame. What about expiration settlement? Well, they have expiration pretty much every day. It's always posted in Eastern time. Okay, so I personally actually set my computer to Eastern time, even though I don't live in the Eastern time zone, because so much news, so many things financially get released in the Eastern time zone stamp. So I literally set my computer to Eastern time. It makes everything line up. I don't have to do any kind of time calculations. And since I don't live in the Eastern time zone, I live in the Central time zone, it makes it a lot sort of nice. When I walk away from my computer, I get a free hour every day. At least it feels that way. Spread range and width, the distance between the floor and the ceiling. Okay, so there's a floor and a ceiling. I'll show you that in a second. And there'll usually be at least one above, one in the middle, one below. And now they've actually expanded it to where they have like 5 spreads and sometimes even more spreads on contracts. And the trading hours are just when you can, enter into a trade. And you can exit before expiration, or you can let it go to expiration, and it'll just, it's like exiting at whatever price the market settles at that moment. Okay, so let's look at a little bit of a graphical representation of what a spread may look like. Again, this could be euro dollar, this could be pound dollar. In this case it's euro dollar, but it could be Bitcoin, it could be S&P 500, could be gold, oil, whatever. So there'll be what's called a master spread. Okay, a big daily master spread. It'll be the widest one. Okay, it's also the one that will mirror the market the most. Okay, so you see that's right in the middle, and what they do is they go so many pips or ticks above or below the market. And then you'll have, like say 8-hour contracts that are still pretty wide. Okay, these are here like 250 pips up, 250 down, and then 125 above, 125 below. So there'll be like 3 of those, maybe 5 of those, depending upon the market. And then you go down to the 2-hour contracts, and notice they're only 100 pips above where the market's at, 100 pips below where the market's at, and there'll be another one that's 50 above, 50 below, so still 100 pips wide. So that just sort of gives you a visual representation of how they'll put these contracts in. So if you want to buy a low-risk contract that has 8 hours, well, you could take advantage of this 250 one. Or maybe you wanted one that was even cheaper, has less time value in it, and you could use this like 2-hour contract. Maybe it has 2 hours, maybe it has an hour until expiration, if an hour has passed since it opened up. But there's a lot of choices, a lot of options, and that's, again, where that scanner, that free scanner over at apexinvesting.com comes in really handy. Let's see here. So, price impact. Price is impacted by where the underlying market is in comparison to the bid and offer. Okay? So that sounded sort of confusing. So there's a bid and offer quote when you buy or sell something, right? The offer is where you buy at, the bid is where you sell at. So when you're doing it, so say that underlying market is, euro dollar or Bitcoin or whatever. Well, that bid and offer of the spread, okay? So where is that price in relation to, where's the bid and offer price in relation to the actual spread? Where is it in relation to the ceiling and the floor? Okay? If the price is right in the middle of the spread, so the underlying market is right in the middle. So, if we go back and look at this again, if the price is right in the middle of the spread, then the bid offer is probably going to be right at where the spread is priced at. Okay? as it moves, it'll get a little bit further away because optionality premium will start kicking in. Okay? That's why I said near the market, the big master contract trades the fastest, more like the market, because it has to move a lot further to get closer to the floor and closer to the ceiling. So again, the bid and offer, the price you buy or sell the spread option at, it's an option, will mirror the market more at the center of the spread, and it'll get optionality as it gets closer and closer to the ceiling or the floor. Okay? The more time there is until expiration, the more premium that'll be in there. The more expected movement that's in the option, then the more premium will be in there. We've had a lot of expected movement lately, right? Because we've had a lot of movement lately. So again, that causes more premium to be in the option. The spread moves in pips and ticks. Okay. Sort of a pip if it's a future. Or sorry, pip if it's, like a forex pair. Tick if it's a future. Some people call it points as well. So just depending upon, what you're used to trading. And every digit is worth $1 per spread. So if you bought, sold the contract, then it's $1 spread. Now this changes a little bit when you get over to the binary contracts, and we'll bring that up in one of our shows as well, where I go into the binaries and how the value actually is not actually $1 a tick. So we'll go into how the price changes a little bit whether you're trading the weekly or the monthly contract. So those are the cryptos are the only ones that are different than $1 a tick. All the other ones, which is nice, you don't have to worry about is it $12.50 a tick, is it $5 a tick, is it $1 a tick, what is it? They're all $1 a tick. Again, except for cryptos. So first, let's go into just how they work. And again, this could be any instrument, Eurodollar, gold, Bitcoin, whatever. But how do they work? So let's say you got a lower and an upper strike, 21.20 to 22, or 22.20 to 21.20. The difference between those is the spread. That's why it's called a spread option. Okay, that's 100 pips worth. And every spread moves in the pip tick quoted in the last digit. So the last digit there is 0. Okay? So every pip is worth $1. And so there's 100 pips, so the spread's worth $100. Right? So that makes the maximum value of the spread $100. So what if I'm selling the spread? Well, I can't lose any additional money above the ceiling. I can't get stopped out either. I'm still in the trade. Now, what if it goes below the floor of the spread? Let's say I capture a 100 pip move. Well, I can't make any additional below the floor, but I still can, profit. And if it stays down there, of course, I'll make the maximum profit. So let's say I sold at 22.10. That's 10 pips. Okay, there's 10 pips difference between the ceiling and the price I sold at. So what would my risk be? If every pip is worth $1, now I can do 10 contracts that are worth $10. You can make it worth more per tick. But if every pip is worth $1, then I would be risking $10. No matter how far up it goes, remember going short, no matter how far up it goes, the most I can lose is $10, and it can come back down, I can still be profitable. Okay? Now the most I can make is where I sold out in the floor. So 22.10 to 21.20, difference there is 90 pips. Every pip being worth $1, so the most I could make would be $90. Now again, if I want to make that 10 contracts, it could be the most I'm risking is 100 to make up to 900 if it actually went down, 100 pips. So if I'm buying the spread, I can't make any additional money above the ceiling, can't lose any additional money below the floor, but again, I also can't get stopped out. Okay? And they have a lot wider than 100. Like I showed you earlier, there's 100, 250, 1,000, so there's some wide spreads. Even wider on the cryptos. But if I go over here and look at 21.30 to 21.20, then my maximum risk is 10 pips. Okay? Which is a maximum risk of $10. $10. I mean, the margin, the money you have to put up to place the trade is $10. You'd have to put up $200 to place this trade on an actual spot FX broker. $200. This is 10. Okay? And you still get the dollar, at expiration dollar for dollar tick. And the most I can make is up to the ceiling, 22.20. Now I can always buy another spread if it moves up if I want to keep going. Or I can buy a wider spread. There's a lot of ways I can do it. But that difference is 90 pips. potential profit, which is $90. Go back and look at that real quick. So 90 pips, $90 of potential profit. Now, I can close this at any time, or I can let it expire. So I can get in here and come down, and I can buy it back. Okay, I could buy it, and it can move up, and I could sell it. So I could literally buy and sell at any price level on here. So if it gets up to 22.20, I could sell it. It comes on down. 21.30, I could buy it back. Maybe it flies down, then all of a sudden it starts moving back up. It breaks out. I buy it at 21.30, 21.40. It flies up. I can sell it. So I can actually trade this multiple times. Okay? So all these arrows, buy, sell, buy. You can go in and hop on them quite a bit. Now, if the spread expires, it will close at the settlement price at the time of expiration. The settlement price is based on the underlying market. They do a simple average, a volume. They can either do price average or volume average, or there's a lot of different ways to do it. One of the ways they do it is they'll take the last 25 quotes, and they'll take the middle 15, and they will drop the top 5 and bottom 5. And I say middle 15, I mean like the highest quotes. They'll drop the highest 5 and the lowest 5 and average the middle 15. Or maybe the middle 15, bid offers, just depending upon the market and how the settlement rules work. And every exchange that has options has a settlement procedure. So this is standard. It's meant to make it where people can't easily manipulate the contract to settle at a certain price. So by dropping the 5 high and the 5 low, you have to put up quite a few contracts sequentially without anybody else interfering in order for you to pull that off. So when the spread expires, so if I bought at 21.20 and it settled at 21.60, then I'd make, or 21.30 and it settled at 21.60, I'd make 30 ticks. Okay? If it's a little bit 22.30, I bought at 21.30, would I make 100? Nope, because the most I can make above is 22.20. So I'd make 90. So 21.30, if it went all the way up to 22.30, would settle for me at the ceiling 22.20. Okay? And that would determine how much I made. If I sold at 210 and bought back at 21.30, okay, then I'd make 80 pips. So through the difference where you enter and exit, or where you enter and it expires, that's how much you make. Okay? So one nice thing about this, you don't have to worry about any kind of margin call. Positions being automatically closed out due to insufficient funds. Or being called and told you owe money. You don't have to worry about whipsaws if you're using the lower risk spreads. They're just knocking you out. Okay? You can lower your risk on a variety of markets. Actually, get into multiple markets without opening up a whole bunch of different accounts. And then often the capital requirement is a lot less than what you're going to be using at most exchanges and brokers. So you don't have to worry about flash crashes, different things like that. So there's a lot of benefits just as a trader. And if you traded long enough, you've seen these massive moves that can cause a massive loss. And then I think this is your risk is capped. You can't lose more than what you put up on the trade. Okay? So let's compare underlying versus spread options. Okay, so we've went into some examples. So let's went into details on the spread contracts. Let's dive a little deeper into things that we need to be aware of as traders, and just look at the two and go, okay, well, what happens if I do this or that? So on spread options, if I go in and let's say I'm looking at this contract right here, and whatever it is, it doesn't really matter. Okay, but let's just say you draw a trend line right there, and you think, okay, it's going to bounce off this and come on down. All right, and that's your expectation. Reasonable expectation based on some very basic technical analysis. Seeing a downtrend and seeing it come back and pull down, come back and pull down, come back and pull down. And so you go in and you're gonna sell right there. And you know what? You're tired of being stopped out, so you're gonna go in and put stop, a really big stop, but way up here above the high, so you don't get stopped out. And you go in and you do that. And you set your stop in just right above the high. And what happens? Okay? Well, you sell at 56.85. You have a stop at 57.50. Your risk here is $650 on this trade if you're doing a full lot. Okay? Which is 100,000 units. And you do a margin of $3,138. What? Who's had this happen to them? Right? Like, tap on, your desk here or whatever. If you've had the market go up and hit your stop, and it seems like wherever you put your stop, then that's the price that it's going to hit. Okay? So it goes up, boom, hits it, you're stopped out. And then to really slap you in the face, what does the market do next? It's like stopped out, and then bam. And so you have the agony when this happens right here, right? Like, I know I'm not alone in this. When the market flies up against you and hits your stop, you go, well, do I go the other way? But then it reverses and gets me. Or do I get back in and go short? Well, then it keeps going and gets me. Or do I stay out and then watch it move right where I thought it was going to go and then miss out? Right? And that just really, really messes with your head. Okay? So if you want to trade without stops and not take on massive leverage, massive risk by margin going, things like that, do it with spread options. And then you can have capped risk and no stops. Okay? So you're not going to get stopped out if you use the spreads. And we'll go into that. So it flies up, it goes against you. And then, bam, flies right in your favor. Right? And then it just makes it, well, I shouldn't have set my stop. That's what happens, right? Well, you don't do that, and then you get cremated one day because you didn't use stops. And you go, well, I saw, a comment about, what about martingelling and things like that where you add on. In casinos, the reason they have table limits is because eventually it'll work if you can put down infinite funds. Eventually it'll come back into your favor if you can keep adding on. But, the chance of having infinite funds is low, but just in case a bazillionaire walks in and Zuckerberg wants to start, just going double down every time, they have a table limit, and that's why they have the limits, so people can't martingale in there. So without having to take on massive risk, you can use these spreads. So you would have lost $650 on that. So let's say we go in and we look at a spread. 5,700 goes way down here. And we look at the contract. The floor is 50 or 50. I mean, we can make 250 pips on this contract. Or it's at least worth 250 pips. And now we got to sell a little bit lower than where the market's at because there's an option, the optionality. Okay, so we're going to sell at 56.65. Now, we're not going to use the stop loss. The other one got stopped out, which was wise because, the risk is infinite. Here, the risk is capped. 35 ticks, points, pips, whatever you want to call it. Maximum risk. So $35 a contract, we do 10 contracts. That puts our risk at $350. Okay? So I can go in here with only $350 and throw on a large position and not have a larger risk than $350. I don't have to add in. I don't have to worry about stops. I don't have to do anything. My maximum risk is $350. And it flies up. I'm down, but I'm not out. And I don't have to add on more risk to get back in the trade and go short. I'm still in the trade. I'm still short, but my risk is capped. Boom, it flies down. Expires at $55.89. I profit $760 on the trade. So let's put these side by side and see what happened. So exact same trade, exact same margin, exact same setup. The underlying spot, I risked $650. The margin was $3,136, and that resulted in a loss of $650 using the FX or crypto or indice, whatever you want to choose. Okay? The Nadex spread doing the exact same trade on the exact same technical analysis, getting in at the exact same time, risked 350 versus 650. Only put up 350 versus 3,000. Okay, trade with a smaller account and less risk at the same time. But still was able to make money on it, make $760. Even though it went against me, max I was down was 350, but came back in my favor, made $760. So, hope y'all learned a lot from that today. And, we'll pick this up and in a future show on the Diagnostic Trading Hour. Again, my name is Daryl Martin from ApexInvesting.com. And I hope you enjoyed the Nadex Spreads and get into them. And, don't forget, I gave you, a lot on it, but there's more to it. And I'll talk to you more about that in a future show. So make sure you tune in. Thank you very much, and y'all have a great day.